We're going to start off with something that I would consider a little bit of humor. And that is right here. So Diana Olick is the representative for CNBC that covers the housing industry. And there is a breakdown from March 2020 all the way back to October 10th, 2011. And these headlines are actually delivered to the public in the exact same month. So in 2020, the economy will be worse, or I'm sorry, the economy will worry you more than the coronavirus. Then, same month, the housing market is roaring to life after the coronavirus-induced slump. 2019, housing market teeters on thin ice with mortgage rates rising. Same month, housing market fears of recession is overblown. And you can go down the list, and this isn't even all of them. And so this is, to me, more along the lines of humor slash headlines slash emotional stimulation, and not a whole lot of information. So that being said, we're going to kick it off, and real information requires time and attention. And so I'm going to ask you to hang in there with me, because this will be pretty dense, but dense is what we all want if we actually want value. So inflation is the key driver to mortgage rates. And there is a misconception out there that it is dictated by the federal funds rate, which I think everybody has heard has been increasing drastically. So here is a chart of the 30-year mortgage rate along with the CPI. And you'll notice that they move together fairly in lockstep until July of 2020. And sorry, I got to admit somebody. And then QE started, which is quantitative easing, which is another word for stimulus. And what that means is the government decided, hey, we need to stimulate the economy. We need to have people buy homes. We need to make it more affordable. We really want people to take equity or cash out of their homes and go spend it at Home Depot and the grocery store and all of those things to avoid the recession that everybody thought the COVID-19 or coronavirus was going to cause. The interesting thing here, though, is how long they decided to do that. So QE, inflation dropped, oil prices went to zero, everything was on sale, there was fear in the market. So I understand why they did it initially. But then you see inflation ripping. And this is insanely drastic. 2% is their target, which is right here. And at this point, it's almost triple. And then they still continue to subsidize the mortgage market even after it actually gets to 250%. So then they finally stopped it. Well, then what did mortgage rates do? It ran after the inflation. And of course, because it was held down so aggressively, it actually, for the first time in a long time, ripped higher than the CPI. And so this is very important to understand mortgage rates and stimulus that is in the financial markets, not something simplistic like stimmy checks getting delivered to the public, although that was still going on at the same time. So how inflation is calculated is on a month over month and year over year basis. And CPI is the Consumer Price Index, which we just got today. And it was another month of great data and mortgage rates improved. And so it is a 12-month rolling average. So if you'll notice June, that's a really high number. So June the following year was likely going to post lower inflation because you're comparing it against a high number of last year. Then we had the summer months into September, which were actually really low inflation prints for those months in 2021. October, we got some grace. And so now each month on a lag, we just got today, November's, and that came in better than expectations. And that means that the bond market is reacting positively to the inflation trend, which will dip mortgage rates down, even though the Fed's fund rate is going to increase on the 14th. So those are a big misconception of correlation and causation. The Fed's fund rate is not tied to mortgage rates. And there is something else that is from the government, and we'll get to that more later. And so as you can see, these next are all pretty favorable comps. So we should have each CPI print put the economy and the mortgage market, as along with the housing market, in a better position. Fed rate hikes and recessions. You can look at this chart all the way back to 1955, and these lines right here, the gray areas, are recessions. And so every time you see them increase the Fed's fund rate, which they've done from essentially 0 all the way up to 4%, which will happen on Thursday, it has caused a recession. And then they lower that Fed's fund rate to soften the recession and stimulate the economy and get out of it. And this is like clockwork, right? For like, what is that? Almost 60 years. And so you fast forward, and even in 2008, they did the same thing. Now we were here, coronavirus, boom, that was the shortest recession ever recorded on history. And now we have the most aggressive Fed's fund hike ever. And one of the reasons, in my belief, is that they had to get that up so they have the ability to drop it back down. And that's why they've been so aggressive. And one of the reasons is they were too accommodative with the QE that I showed, the stimmy checks, PPP loans, disaster loan relief, all of these things, along with some of the bills that didn't pass, but it really scared the market and caused inflation to go bonkers. Another misconception is the unemployment statistic. You would probably intuitively think that if you had a very high unemployment, that would indicate a recession is around the corner. And in actuality, it's the opposite. It is when the unemployment rate is at its lowest point. And that's generally because there's a plateau. The unemployment rate usually does not stay at its lowest point. So again, this chart is the unemployment rate, and here are the recessions back to 1950. So unemployment rate super low, recession hits, it skyrockets, low, skyrockets, low, skyrockets. And COVID-19 caused a very weird metric because everyone was essentially forced to be unemployed temporarily. And, but it is no different. And the unemployment rate off of its low of 3.5% is now at 3.7%. And ironically, the 2 quarters of negative GDP happened when the unemployment rate was 3.5%. And we're not going back down. We're going up from here. And then maybe not some of you in the housing industry that have been around for a while, but most people think the opposite of what is true with rates and recessions. So mortgage rates go down during recessions. And again, you can go all the way back to 1980s where mortgage rates topped out at 18%, which of course we think is absolutely insane, but it did happen. And then we trickle on here to the recession, boom, again. And then you have some sidewinders, but it still holds true. Mortgage rates during a recession go down. And one of the reasons is because real estate usually pulls the economy out of a recession with cash out refinances, tied up equity that is incentivized to be taken out and spent in the real economy, which creates GDP and job growth and all of that. So you'll see right here at the very bottom, we're on our way up as fast as humanly possible is what it looks like. And what it looks like to me is so that we have the wiggle room to do what we've done in the past to stimulate the economy. If you sit at a 3 or 2.5 or 3.5 mortgage rate, there really is no room to go back down. So you would think that during a recession, housing would be hurt. And you'll notice this graph has one particular recession that is an outlier. All of these from 1960 is your home price index. And essentially it keeps going up and then it starts to actually go up, which means homes are becoming more expensive or appreciating at a faster rate. And that essentially continues all the way until 2008, 9, and 10. But that is because the housing industry and the financialization and the lack of scrutiny on underwriting standards and household formations and home builds actually caused that recession. So that's where you see that massive dip. And I'm going to outline that in a little bit more detail. So 2006, 33 years earlier, was right here. This is a chart of birth rates. And so for the previous decade, they'd been building way more houses and the birth rate declined. And 33 years old was the average range of the first-time home buyer. And they got themselves in a pickle. And part of the reason is because to build a home from start to finish does take multiple years with development, permit processing, building the home, and then actually selling it to the consumer. So these are long projects that were already underway, and these private builders were already pot committed. And they probably didn't look at this trend previous to those endeavors either. So now we're on to housing inventory. When you look at this, unfortunately, we are not gaining new inventory in the new house supply. So this is a rolling average from 2021 to 2022. So housing starts completed are 1.4 million, which is pretty darn good because that's a lot higher than it was the year before and the year before that. But there's about 100,000 that are annually destroyed because they're just not habitable, and it's time to renovate and destroy and rebuild that property. So the new supply is 1.3 million, but household formations are also 1.3 million. And builders are cautious and they learn their lesson from the 2006 to 2009 era. And then if you look going forward, which is not anywhere on these charts, after the Fed decided to make money or capital more expensive, you're seeing those permits plummet. And so that poses a problem for the near-term future because all of these builders were gung-ho trying to catch up for the inventory deficit. And then they were incentivized to pump those brakes really hard in order to not repeat the same mistake of building too many homes. And this chart is like the home run chart, in my opinion. So 2007 was the height, and that was 4 million units of inventory on the market. And if you fast forward to 2022, we have 1.25 million. And you'll notice, I mean, that took many, many years, almost a decade to trend towards what the market actually needs. And so this slide is a big deal because 1.5 to 4 million is really difficult to have a housing crash when you're in that much of a housing deficit. And arguably it might be impossible, but I won't say that. So everybody's been saying, or many people have been saying, that there is an inventory rise as of late, and that would be true. You can look at March of 2022 to basically August or September, and that was a massively aggressive increase in the existing inventory market. We just went through new homes, now it's existing. Well, if you zoom out, that is a very normal seasonal cyclical pattern. And what you see here is 2014, 16, 18, 20, all these are trending down. And then I'm just gonna hang tight with me. Where are we at right now? 36 years minus 2022, we're right here. We have more household formations coming up for the next 3 or 4 years consecutively. And we do not have a major drop. So, although the spring market, more houses come on the market, we are still below what we need. And here's the real story. It said that there was 1.25 million existing homes for sale. But when you dig into it one layer further, the existing home inventory is calculated at 1.25 million. But that includes the properties that are under contract, which are 518,000. So actually, the actual inventory available for sale and purchase today is 732,000, which is 500,000 short from the advertised 1.25 million that is on most information outlets being posted. And I decided to pull this chart because it went back to the day I was born, basically. But this is a recap of 2008. And this is also the Case-Shiller Home Price Index. And it trends upwards, right? We had a little bummer here, but why did that happen? There was a massive mismatch between annual completions and household growth. There was also poor or non-existent underwriting standards. And if you get a loan today, you know that we underwrite it almost too aggressively, but that is what was missing. You did not have to even validate your income or your job. There was no asset verifications on where that was coming from. And then Wall Street created financial products that bundled subprime mortgages with AAA credit rating mortgages. And then the whole bundle was just said to be essentially risk-free. And in fact, it was the opposite. And although that was unfortunate, the industry has learned from it. And so that's actually something to be proud of from a regulator's point of view, which doesn't happen too often. Now, this is a zoomed in chart. So this is a depiction of that. And so we are increasing at a far more rapid pace. And these are annual numbers. So in 2020, it was 4.4. And then all of a sudden we started to rip up here. And why did that happen? It was from quantitative easing, holding interest rates artificially low, stimulus money, also habits and people's behavior around COVID and privacy and space. And so all those things were like a perfect storm to generate this type of appreciation. And you'll notice here, it looks like it's going down just a titch. But I wouldn't be fooled and think that is permanent. Home prices are up 41% since 2006. So if you were to look at this graph right here and you would have bought a home in 2006, it would still have appreciated 41% today. And that includes all of the carnage that happened during 2008, 9, 10, 11, and even 12. It kind of started to take off again after 13 and 14. Rates were over 6% back then. Rates were under 3 in 2021. So again, this would lead you to believe, oh man, that dip is going to continue. Well, that's not the whole story. Because incomes are up 55% from 2006. So home prices are up 41%. Incomes are up 55%. But who do you know that spends 100% of their income on their housing? Nobody. Right? And so there is an affordability challenge in the market, but it does not resemble the same scenario of 2006. And that excludes all of the inventory graphs. If you just compare those side by side, we are still in a more affordable environment today. And so hang tight if you can't read this, it's pretty dense, but I had to jot it down because the entire thing is essential. So the media has been negative on housing for the last 10 years and essentially said, don't buy a home. But since then, values are up 115% from 2012 and 39% just in the last 2 years. So the media has been pushing that housing is in a recession and that home prices are on a sharp downturn year-over-year basis. Year-over-year appreciation has decelerated from 20% to 13%. Yet the media claims it's the biggest decline in history. But this is just a decline in home price appreciation, not a drop in home values. The actual appreciation, according to Case-Shiller, is only down 1.5% nationally from its peak. And as we all know, local markets are not national markets, but this is essential to understand the full picture. And it will likely come down further over the next month or maybe two, as peak interest rates have not been fully factored into those sales. But if you've been following it, we're already off of the peak mortgage rate. So once those close, which is basically this month and next month at the very latest, those sales will populate. And that's why I do believe there's a hidden opportunity right now, and it may not last as long as most think. So let's compare a deceleration of home appreciation in the past. In 2018, year over year deceleration was 6.5% appreciation, down to 3 in 2019. That's a 55% decrease. Keep in mind, home prices are still going up in that example, while we still saw the home price gains. And then we saw a deceleration in 2021 as well, while still seeing the price gains. Looking from the peak in 2021 to today, the year over year appreciation went from 20% to 13%, which is only a 35% deceleration. But the media is not telling you this in full context. While there might be additional softness to come, depending on what market, what neighborhood, and what home you want, we do think that when rates come down to 5% or nearby, we will see a reacceleration of appreciation. And that's like right around the corner in our opinion. And I'm going to outline why we do think that. So here is a chart that is a little bit technical, but all I want you to take from it is that the Fed's fund rate does not dictate mortgage rates. So when they say they increase it, that is a different sector of the economy. The 10-year treasury note or treasury yield is pretty indicative of mortgage rate trends. And you can see that right here. Now, the spread is something that's been a massive problem of recently. There's a 300 basis point or 3% spread. Why is that? It's because the investors and everybody on the other side of the transaction does not believe that the mortgage rates funded at 6, 6.5, 7, 7.5 will be around. So there is no servicing value. Nobody wants to buy them. And so what the customer must do is pay discount points up front so that loan can be funded. That's why as of recently, it's been really hard to get a mortgage rate without paying for that mortgage rate. For a long time, everyone's been used to, okay, I can get 5% and it costs me nothing. That is trending in the opposite direction already. This yield spread is already getting better. So I'm a little late to the game on this slide. And on top of that, the 10-year treasury note is not 4% anymore. It's already on its way back down. So when the spread closes and the 10-year treasury drops, that is how we're going to get to 5% in short order, call it in the middle of this coming year. And of course, that lands in the summertime where the activity is generally higher anyways. Just like you saw in that chart, the inventory goes like this. And it's because the activity and buyer demand follows that. So here's some appreciation insights that are not as attractive as 20% or 13%, but nevertheless, this is pretty impressive in my opinion, considering the roller coaster that we've been on. So I'm going to highlight this and I'm going to hit it home, and I think we're getting to the last slide. So the current appreciation in the month of October is 11.4% year over year. And that is fantastic. That's double digits, even though the month over month was down, right? So we're trending down. But this is from September 22 to September 23 for this 3.9% appreciation projection. And remember, that means prices are still going up. So waiting is probably just going to be more expensive. Now, if somebody needs to get their own personal situation straight, I totally understand that, and that's highly advisable. But to think that the world is coming to an end and there's going to be a market crash, I would say is being misinformed. And I think 3.9% is totally undervalued. I think that's super respectable, and I would love to have that for myself, because I'm going to skip this. I already went through this in detail. Because here's an example. If you bought a $400,000 house with a 10% down payment, and it doesn't need to be 10%, but this was really easy math. There's different programs, 3% down payment assistance, and we can explore all of those should anybody want to at a later date. But 400,000 home purchase, you would put your own money of 10% down in this example. And I used a 3% appreciation, not a 3.9. And then you divide those together, 12,000 divided by 40,000, and your return on investment is 30% in 1 year at an appreciation rate of 3%. And that is through the power of leverage. Real estate allows you to leverage that asset higher than any other asset class, to my knowledge. And 30% is just unattainable in the markets. If you were to explore a well-respected fund manager and they got 15%, they would be considered the top 1% of their profession. And you're not allowed to leverage that, right? So you got to come up with those funds dollar for dollar in order to get those returns. And then on top of it, you have to live somewhere. You got to pay a living expense somewhere. Maybe you can live with mom and dad, but this offers the whole kit and caboodle: freedom, privacy, home ownership, investments, all of the above. And so this is why real estate is a beautiful asset class, and that's why I'm in the business. So thank you very much. And here is our lending team. We have a great squad, and Dimitri certainly helped me put this bad boy together. So thanks to him. And we also service our own loans. So like I said, everybody expects these newly created loans to not stay on the books, but we do not sell our loans on the secondary market for money one time. We keep them, house them, monitor them, and help our past clients make sure they have the best loan going forward to maximize their wealth in home ownership. And just to give you some numbers, we service $69.1 billion of loan, and we just beat out Rocket Mortgage, which held the #1 customer satisfaction for 7 years in a row. And so we've serviced 97% of our own loans, and the other 3% would be our other outlets, so we have variety for our clients. So thank you very much. I think there's tremendous opportunity, and whether it's now or even in the springtime, I still think that making a decision to move forward and getting your ducks in a row and your clients understanding this information, which is actually kind of difficult to understand because you will find only highlight reels that are not the full picture. And those are very easy to find believable, in my opinion. But all of this combined looks like it is as good as any opportunity. And if you can qualify at these higher mortgage rates, you're in a great position. When there's massive pessimism in the market, it generally speaking is the best time to buy. And that's unanimous in any asset class, whether it's the stock market, the crypto market. When everything was essentially euphoria, it is much more difficult to make a level-headed purchase because the euphoria has everything overly stimulated. Your decisions have to be fast. There's more participants in the market, and it's very easy to get yourself in trouble. And now is the time where Warren Buffett says blood is in the streets, right? There's not actually blood in the streets. It's just that all of your competition thinks there's blood in the streets. And so this presentation was designed to show you that there's a lot of stability going on. And so thank you very much, and hop in with any questions if you guys have any.
Matt, I have a question for you.
You got it, shoot.
This is Kevin, not Anna. I just happened to be on her computer.
Oh, well, luckily I could see your face.
Yeah. Well, thanks so much. That was great. I think the one graph that I was looking for, and I don't expect you to come up with it out of thin air, but the affordability or housing affordability index. Do you have any insight on that? And is that something Dimitri could find? I'm just curious because I think you showed, what the average income was in 2006 and where we're at now. but I often hear the affordability index and that being a factor in it as well.
Yeah, and it's definitely not as affordable as it was just, let's say, last year, because those rates made it far more affordable comparatively than price increases, right? And so Dimitri can definitely find that. We can pull it and we can provide that to you. And there's essentially a ratio, and it's individualized. How much do you spend on your housing payment? And that was at a low of like 19%, compared to 2006, which was closer to 30. And in reality, we are closer to that 30 mark if you were to compare it to a 7.25% interest rate, which was literally like last month. Now it's almost to the point where you can get a 6.25% interest rate. So that affordability index needs to be recalculated even from just 30 days ago. But we'd be happy to do that, and it probably should have been in here. So thank you very much.
Yeah, I think that's just to me, one of the metrics that really is one to watch. Just because, and then, who knows about credit cards and all of that, because who knows what percentage of the population doesn't have a lot of debt or can just move forward and buy what they want. I think we've learned that over the last 2-3 years, is if somebody wants it, they're just going to find a way to do it. But yeah, I guess I would just be curious what your thoughts are. Like, was that one of the reasons where then that recession made people lose their jobs, plus their affordability index was terrible, and that was part of the reason for the last recession?
You're talking about the 2008 massive housing recession.
Yeah, obviously it was more the underwriting standards and stuff, but do you have thoughts on affordability index as well?
I think that certainly did not help. Do I think that you would have had such a catastrophe if homes just became unaffordable? No, because I think there would have been a slow decline in prices to match the market capabilities on the demand side. Instead, we really did have a financialized housing market that was really unregulated, and I'm lacking a term that isn't offensive, but it was irresponsible, right? You had people buying homes that were not required to prove anything. So affordability literally didn't even matter. You can take an affordability index from 2006, but that actually didn't matter. You could buy a home and not afford it, guaranteed, right? So we don't have those things today. And so do I think affordability is a little bit of an issue? I do. And I didn't get into this, but if you look at multifamily housing, there is a lot of inventory coming on the market nationally for multifamily housing. And so, where my head goes with that is that affordability will continue to be a problem for what people want. But currently right now, with the supply side, there is enough buyers that do have the ability to afford to buy those things. It is unfortunate for people that do not, and they may have an easier time renting as those units come to market, because hopefully that'll put some downward pressure on rental rates. But if there is not enough homes for the population that needs housing, and there's enough population that wants housing that can afford and does buy homes, unfortunately, the general affordability index based on the incomes and the cost of mortgage doesn't actually apply unless you have enough inventory to satisfy the market. Does that make sense?
It does, yeah. And the other question I had is, what are your thoughts on appreciation year over year? You mentioned 3.9 seemed conservative to you.
Yeah, I would say that in the near term of the next 12 months, there's a couple things that have to work out correctly for that to be higher. And I think we're seeing all the data come in as of recent that will bring mortgage rates down. And So I do believe that it is a conservative number. Now, in certain markets like San Francisco and some of these ones that are up almost 50%, kind of excluding those massive outliers, but the Midwest is pretty stable. And so what can derail that though, in my opinion, is probably international geopolitical stuff and the energy markets. And so of course, there's always the unpredictable, but I think that if you're in the desire to buy a house for non-financial reasons, like your family and different stuff like that, how does it make sense to make or be scared or make a decision off of something that's so unknown? Because every other piece of data says that we will have a Fed's fund rate start to lower in 2023, and we will have that servicing value come back. And with that being said, there will be pent up demand that you're seeing. And if you have anecdotal evidence, like you're a professional in the industry, you have seen a lot of people that actually, I have seen a lot of people that actually can afford to buy right now, but they are choosing not to. And that's respectable for all sorts of reasons. But just like I said, when the euphoria hits the market, for some reason, a lot of those people jump back in instead of just taking the 7% rate, buying what they want, and then lower their payment when they already live in it with a refinance. Of course, you would still have to find what you actually want, in my opinion, which isn't the easiest thing. There's not a lot of choices. And I don't think that's going to change in the next 12 months. And I think it's just really hard to build a new home for the first time home buyer market. So you have to incentivize the people that are living in split levels and some of the lower priced inventory selection to trade up. And that's really difficult if they have a 3% mortgage rate. But that might be not as difficult to trade to a 5% for all the amenities that would get you. And you know, that's my kind of 2 cents on that.
Agreed. Thank you.
Yes. You know, there's always black swan events, but I think if you're planning your life around those, you might be just hanging out doing a lot of nothing.
We all know those clients hanging out
Yes.
doing nothing.
Yes. But thank you for your question. I really appreciate it.
Yeah.
Does anybody else have anything? You can feel free to comment and interject your own opinions as well.
Thanks for putting this on, Matt. This is very informative. I love it.
Thank you for the feedback. I really appreciate it.
Yeah, no problem. I'm not going to go on camera, but you know, it's interesting because when you look at the markets right now, we're seeing the affordability has gotten so low right now. I mean, everything is so expensive, and to me, I mean, with interest and everything, when you look at your actual mortgage payment when you purchase a home, and what that actually shows me is that the market is showing us that they value home ownership. Because you've seen just this tiny little dip in prices, but you've seen this huge increase in the actual payment that people are willing to pay to own a home. It's so hard to see a crash on the horizon because of that, because the market is saying, yeah, I don't care if I have to pay $2,000 or a month for a $250,000 home. That doesn't matter to me. I just want to own a home. So kind of right in line with everything you were saying, but that's my little, you know, my little nugget of whatever for everybody watching, for whatever it's worth.
I agree with you. I would say that I'm like hindsight 2020, relatively surprised at the willingness of the market to come in and still participate at these higher rates. And I really think it's just like, hey, put yourself in their shoes. What is the actual alternative, right? You can complain about things, but what's the alternative? And living for free at home is actually still, again, at an all-time high. And so I would imagine that's still pent up demand. I still believe that those people do have ambitions and desires. They are just not mentally capable or financially capable of going and making that jump. And there's just a ton of that going on. And the people that are coming into the market, they are backstopping the price declines. And sellers are not super willing to take a massive haircut because likely they are trading up to a more expensive payment for something they want and desire, but they don't have to sell, right? And so there's a lock-in effect, and that is going to be semi-permanent, I do believe. Not everyone will make that trade, especially people on fixed income sources. They just might not have that ability. So that will be tied up inventory on the market. And you know, Kevin, you're probably more hip on this than maybe even I am. But you know, I bought one, two, three homes in my life. I've never sold them all. I've never sold any of them. They're all rentals, and I'm not the only person doing that. And that trend is becoming more common because when you look at the return on investments to other sectors, and you're giving up control to other people that hold your money, it's not that great of a trade. The trade is pretty great as long as you can handle some headache, is to keep that home, go buy a different one, rent the other one out. Well, guess what? That piece of inventory is not available for home ownership anymore. And that also is going on, and it's hard to track, but it's certainly widespread. All right, guys, you have yourself a beautiful day, and have a great holidays and Happy New Year. And you can feel free to share any of this. If you want something specific, like a slide or something to give to clients, just reach out to me and Dimitri.